Thank you. Yeah, I do. Let me get set up first. I don't have a pen. I'll ask you here in just a moment. Thanks for that.
That.
Yes, sir. Yeah, that's perfect. That's just fine. Cody, you were right. The syllabus does say that we have a recorded lecture tonight.
Okay, I thought it was going crazy.
Yeah, it kind of overlapped onto 2 pages and I didn't catch it. So that's my bad. We'll have a light class tonight. I'll have to send out a note to everybody after we get this one recorded. I'd swap it up, but next Monday night is Monday Night Football and
Oh,
I'm not about to lecture over the Chiefs. That's not going to happen.
you missed that class, but in case.
Nobody wants that. Tom, what company are you working on? Alpha Point. I don't know those guys. What do they do?
So, you know, people really want.
Yeah. Yeah.
You know, jobs, we're manufacturers primarily, but then we also have, economics on that. For reproduction.
Oh, that's the company you work for now? Okay, gotcha. What is your research project?
Oh, Cintas.
Oh, right there. Okay, Cintas, gotcha. Nice. Well, I'm interested in Alpha Point too. I just had to ask a different question, so yeah. Okay, gotcha. Appreciate that. Who's the other guy in the picture? All right, what's his name? Tommy is 14. Do I have a 14-year-old? Just turned 14. Gonna be 8th grader now, gonna be a freshman next year. Wow. Okay, I got 14, 16, 18, 20. I'm right there with you. Thank you, and Fatima, where's Fatima? Do you go by Fatima? Fatima, is that, did I say it right? Okay, and what company are you working on? Cardinal Health? CAH? Do you know the ticker symbol? When you go to Yahoo Finance, do you know the 3-letter code that you type in to get Cardinal Health? We can look that up together. CAH, that's. Yep. Perfect. Okay, and Bishal, did I say that right? Did I say it right? Okay, terrific. What company are you working on? PepsiCo, PEP, right? Okay. You're gonna have to help me with this pronunciation. Apoma? Not here. Okay. And Pravalika? Not here either. Okay. That's my bad. Cody noticed an error in the syllabus, so I don't have to apologize to anybody here because you all showed up. But the syllabus shows that tonight is supposed to be a recorded lecture. We have established an on again, off again cadence. So all of you recognize that we were in for class and showed up. So thank you very much. I'm gonna have to reach out with a note of apology to everybody at the show and explain to them where they can find the next recorded lecture. And we will not be on ground. Then we'll be back to our normal cadence. So in the last couple of weeks, was everybody able to navigate out to the My Business Course website and successfully take the exam? Okay, perfect. Any questions about that process, exam? No comments, no points. Great. I looked last week and the few that were in were very good. I was pleased. I didn't receive any complaints throughout the process. So I'm going to assume that we are on schedule there. Tonight's lecture is over module 6. Module 6 talks about the asset side of the balance sheet. We're going to be talking a little bit about inventories tonight, asset recognition and operating assets. So asset recognition is a broad topic that addresses when we actually put something on the balance sheet. And when as that pertains to inventory, we generally put our inventory on the balance sheet as soon as we buy it. And then we'll add work in process and other overhead costs associated with that as that inventory moves through our manufacturing process. Ultimately off of the balance sheet and onto the income statement in a category that we call cost of goods sold. We'll talk a little bit about that tonight. The most important part about inventory is that there are several different costing methodologies. I would expect for those methodologies to sound familiar. It's been a couple of years since you took accounting, and you might want to pay closer attention, but if it's got the accounting side of it, then you can pretty much sleep during this discussion, because there's nothing new about inventory costing methods. We're gonna talk about LIFO and FIFO. The one thing that is relevant to what we cover in this class is how those LIFO and FIFO costing methods ultimately work their way into the ratios that we use to compare different companies, and the ratios that we use to compare the companies that we're looking at today to their prior versions. We want to be able to understand that days inventory outstanding, and I'm just picking the ratios, if days inventory outstanding has been increasing from 90 days to 85 days to 80 days to 70 days. What's driving it? What's going on inside that company? What decisions are your management teams making that's driving those efficiency measures? And most importantly, the finance classes is not an accounting classes, finance class. What's important in finance is whether or not we think those efficiencies will continue into everything that we do in here, all the number crunching that we do in here is ultimately to get at what do we think is the best case scenario? How do we take all this information and kind of amalgamate it into the highest information forecast that we can do? We're gonna look at inventory costing tonight. We're gonna look at property, plant, and equipment tonight, talk a little bit about how that makes it onto the balance sheet. And then we're gonna look at various measures and methodologies for calculating depreciation. Again, if you've had accounting recently, then this is gonna be a very easy lecture because it's all review. We're gonna start with straight line depreciation, look at two methods of accelerated depreciation, and we want to make sure that we have a good grasp on how the different measures of depreciation flow through to the income statement. What do those different measures do to the ratios that we're using here across company across? And we'll make some adjustments if necessary. And then lastly, we'll look at intangible assets, and that'll be our class tonight. So please interrupt me with questions as we go. Okay, let's begin with this little slide that shows how inventory ends up on the balance sheet. Our authors give us a nice little graphic here. We have all of these costs that flow into a typical manufacturing business. We're gonna go out, we're gonna acquire raw materials, and we're gonna do something with those raw materials, and so all of those costs get posted to the balance sheet as assets. Usually inventory from work in progress, if we have a manufacturing firm, it's not take more of several housing starts, housing builds, and then as we add manpower and various other inputs during the manufacturing process, we're gonna record those to the balance sheet and ultimately move those over to the income statement. And those three broad categories that we're gonna keep track of show up here as direct raw materials, cost of direct labor, and manufacturing overhead here at the bottom of that slide. The terminology that accountants use to describe this process is called capitalization. Anytime you hear the word capitalization, that means nothing more than we're taking something and we're putting it on the balance sheet. Capitalization equals on the balance sheet. And then we're going to expense those items over time With inventory, we expense them as cost of goods sold. With property, plant, and equipment, we expense them as depreciation. And with other assets, we may expense them with an amortization schedule, or in some cases, we just assess them annually for any impairment. So our basic formula for tracking cost of goods sold is beginning inventory plus any inventory that we've acquired during the period, typically 30 days. Could be quarterly, could be annually. Those two inputs, beginning inventory plus inventory acquired, equal cost of good available for sale. Total amount of goods that we have. When we subtract off ending inventory, we get cost of goods sold, which represents everything that we've pushed through or completed during that period of time. 30, 60, 90 days, quarterly, annually. That's the same basic equation that applies to every period of time. So let's look at gross profit under various inventory costing methods. Gross profit is a very simple calculation. We're just taking sales less cost of goods sold. Get gross profit. And it's a key indicator of costs that flow through to the income statement. This word at the top of the screen here, this choice, gross profit and managerial choice. What do you hear when I say the word choice? I want, anytime I say the word choice, anytime I say the word estimate, anytime I say that various accounting methodologies. In this class, all of those should point to one conclusion or one conversation topic that we keep coming back to. Ever since the first night of class, when we looked at the prophecy assignment, I asked you to clearly identify one number. Remember the prophecy assignment? The basic point of that assignment was to identify how management teams get paid. And the point of knowing how they got paid is so that when there are various accounting treatments available to us, we want to understand if the management team is incentivized to select one accounting treatment over another. And in order to identify that, we have to know how these different accounting methodologies affect earnings per share, or return on invested capital, or any other of the multiples that your management team's incentive compensation is linked to. So when you see this term choice, I want you to clearly understand that, oh, this is one of those conversation topics that might allow for some, I call it shannon. If you wanted to game the system, if you wanted to use accounting to affect earnings per share or some other metric that ultimately lined your pocket and got you paid, this is where you would do it. So tonight, we're looking at various methodologies for accounting for inventory. So think about this conversation through that lens. Okay, I know how my management team gets paid because I did that proxy assignment. I know their comps linked to earnings per share. Which one of these accounting methodologies would get my management team paid? Which one of these accounting methodologies would trigger that stock option package that was in the proxy week 1? And the three costing methodologies that we're going to look at are FIFO, LIFO, and average cost, all of which should be reviewed. I'm hopeful that they're reviewed. FIFO first. Okay, let's look at this. First little analogy, top of the screen, assume the following inventory records. So we have inventory on January 1st of 500 units, 500 units at $100 per unit equals inventory of 50,000. We purchase during the period an additional 200 units, but now those units cost 150 per unit. So something's going on in the economy, our inventory costs get to increase by 50%. That's huge inflation there, but we're simplifying this example. So our total goods available for sale, remember, total goods available for sale equals beginning inventory plus inventory purchase during the period, 700 units. at an average cost of, or a total cost of 80,000. So we know that our inventory sold during the period was 450 units at 250 per unit. That's the selling price, not the cost. For a total of 112,000. So now look at this FIFO inventory costing method. We're gonna take our sales less cost of goods sold, 450 at 100 each. Where do we get this 100 each number? We get that 100 each number from right up above, 100 per unit. That was our beginning inventory, 500 units at 100 per unit. First in, first out. Those 500 units at $100 per unit, those were sitting in our inventory first. Those are the oldest units. First in, first out. So we cost each of those at 100 each. That helps us calculate a total cost of goods sold of 45,000. Subtract that from sales to get gross profit of 67,500. Okay, now let's look at LIFO. Same numbers, only this time we're using a last in, first out methodology. So the last inventory that we bought flowing through to the cost of goods that we just sold on our income statement. And the last inventory that we bought, again, this is the same table that we just looked at on the last slide. The last inventory we bought was at $150 per unit. So 150 per unit. We sold 200 units at that price. And then we sold an additional 250 units at 100 per unit because we only had 200 units at the $150 per unit price. So 250 units must have been cost at $100 per unit. Add those up, we have total cost of inventory of 55,000 and gross profit of 57,500. Okay, what was our gross profit under FIFO? 67,500. So there's the answer to the question. If you wanted to game the system to increase your earnings per share, which inventory methodology would be? Well, one that generates the higher profit. Which one generates the higher profit? Not this one. The other one was higher. First in, first out generates the higher profit. Okay. Now, would it surprise you to learn that very few companies use first in, first out, and all right, am I saying that right? First in, first out generates a higher profit. Last in, last out generates a lower profit. So yes, would it surprise you to learn that most companies in the United States use last in, last out, and willingly record lower profits? Why would a company choose to do that? I think you said it. Taxes. So if you record a lower profit, then you're going to pay lower taxes. Economically, this is the exact same thing. We just took goods from our warehouse, we created finished product, we sold that. It didn't affect our selling price. This is just accounting treatment. We can choose last in, first out inventory costing methodology, or we can choose first in, first out inventory costing methodology. If one of them gives us a lower profit, we're going to pay lower tax. At the end of the day, we're going to have more cash on hand. Lower taxes is a superior economic proposition. If you owned the company outright, if you owned 100% of the shares, well, you would pick a lower tax rate every time. I raised this whole notion that management can sometimes play around with the accounting to increase earnings per share, maybe trigger their options package, and you do see that. But the quote unquote correct decision should be the one that minimizes your taxes. And you do see that most of the time. You do see most companies opt for LIFO reporting because it doesn't minimize your tax. one of the peculiarities about GAAP accounting in general. That this even exists, because you can't do it anywhere else in the world. The United States is the only country in the world that allows for LIFO inventory costing method. Everywhere else is just FIFO, which begs the question. Why would we just do it like everybody else in the world? So that our reporting was consistent and everybody loves picking on corporations, especially during the political season, right? And it's a subtle additional tax on corporations, which everybody loves because they're kind of blind. You know, the easy person to pick on when you want to raise taxes. I haven't been able to get a good answer to that question. I think it's just kind of an anachronism of this exists. Nobody's been able to do away with it yet, so we all have to know it. And the more complex and convoluted the tax system is, the more the higher CPA salaries are out there in the real world. So there's always something to celebrate about this opaque and esoteric tax treatment. Average cost is another methodology that is kind of a middle ground, rather than assuming that all of the inventory units that we sell are last in or first out, or we have to identify their costs discretely. We just say, well, let's calculate the average of all the units that we have on hand and use that to figure out what each one costs. And it's just that simple. So in this instance, we had 80,000 units. We had paid a total of 80,000 for 700 units. That equates to an average cost of 114 per unit times 450 units sold. Gives us a gross margin of 61,000, which is right there in the middle of what we were looking at between LIFO and FIFO. And that's an acceptable methodology to use for taxes as well. Our authors talk a little bit about retail inventory costing. If any of you are working on a retail costing on a retail company, if that would be like the GAAP. There's another methodology called cost per retail percentage that might come into play. So I'll let you take a look at that if and only if it's relevant. You don't see it very often. Okay, our authors give us this nice summary page that shows the sales, cost of goods sold, and gross margin for each of the inventory costing methodologies. They're different primarily because of inflation. If we don't have any inflation at all, if the costs of goods are not changing from period to period to period, then LIFO inventory and FIFO inventory will be exactly the same. In the example we looked at before, all of the inventory in our beginning inventory number was costed $100 per unit. Well, if there's no inflation, that doesn't ever change, and it stays at $100 per unit, then LIFO and FIFO will be the same. But in normal periods, you generally get a little bit of inflation, which makes LIFO result in the lower gross profit number. It makes it advantageous from a tax standpoint. And the IRS knows this, and FASB knows this, which is why they said you can use LIFO, but if you do use LIFO, you have to report something called the LIFO reserve. And the LIFO reserve is a number disclosed in the fine print that tells us all as analysts what the company's inventory would have been if they recorded it as FIFO. So on the balance sheet, you have an inventory number, and in the fine print, you have a LIFO reserve. If you take that LIFO reserve number and add it to the inventory number that you see on the balance sheet, then the result is going to be the inventory you would have reported if you were using FIFO. Here's an example of Caterpillar reporting LIFO. So in their fine print, they say we state inventories at the lower of cost or net realizable value. We principally determine costs using last in, first out method. The value of inventories on a LIFO basis represents about 60% and 60% of total inventories, respectively. If the FIFO method had been used, inventories would have been 3,321 million. Higher than reported. So this number right here, this 3,321, is the LIFO reserve. They don't explicitly state our LIFO reserve is 3,321. They kind of define it. They say if we had used FIFO, those inventories would have been higher by 3,321. Other disclosures will just simply say our LIFO reserve is 3,321. Then you have to scratch your head and think to yourself, now what the heck was that again? Cash flow effects. Can't remember if we're still looking at Caterpillar yet. So Caterpillar. They show their LIFO reserve is 3,321. That means that they have expensed. I guess it's probably $3,321,000,000 pushed through their. That would not have been pushed through their income statement if they didn't use FIFO. Which means that's effectively a tax shield. So if they pay a 30% tax rate. Right up here at the top, Caterpillar, for example, has saved 968 million in total taxes over time. So yeah, it would equate to about 30%. $968 million in taxes. They'll eventually pay those taxes. Time being, they've been able to deploy that cash in other places. Right there on the slide, 35% tax. Okay, let's move on to our next learning objective. We'll talk about 6.2 and examine inventory disclosures. Okay, here's your. Here's your playbook for your homework. It's likely you'll get a homework question or a question on the exam that asks you to convert FIFO inventory to LIFO inventory, or how you would make the adjustments. And that's 1, 2, 3 right here on the slide. So you have the basic formula: FIFO inventory equals LIFO inventory plus LIFO reserve. And we want to make 3 adjustments to convert LIFO to FIFO on balance. First, we're going to increase the inventory by the LIFO reserve. We're going to increase the tax liabilities by the tax rate applied to the LIFO reserve. So we just saw that Caterpillar saved 968 million in taxes. In order to make the conversion, we wanted to restate the balance as if they could use FIFO. We would have to report a tax liability for the amount of $968 they owe them, they own the balance. And then 3, increase the retained earnings by the FIFO's more profitable, so more of those earnings, while they would have to pay tax on those earnings, the difference ultimately flows through to the bottom line. And when you take each of those steps and apply them to Caterpillar's balance sheet, like we just did, well, we know inventory increases by 3.3 million. We know the tax liability increases by 697 million. That's utilizing the prior year's tax rate of 21%, which in turn increases retained earnings by the difference for a total of $2.6 million that they just run through their earnings. Okay, let's look at some ratios here. When you look at these inventory costing methods, I want to go back to gross margin. We applied several inventory costing methodologies and deducted each of the cost of goods sold from sales. The resulting measure is gross margin. When we look at gross margin, we're going to see fluctuations. When you analyze your companies for your semester project, I want you to look at those fluctuations relative to your peer groups and also relative to historical analysis. So if you look back over the last 5 to 10 years and you see a fluctuation in gross margins, maybe that comes from the way your company's managing their inventory. Our authors give us a good example here. Gross margin as a percentage of net sales was 33% in 2022. The decrease in gross profit margin was primarily driven by, and then we have, they tell us, well, here, this is what's going on inside the company. And again, you're looking for sustainability here. You want to take these reasons and analyze them and come to some conclusion about whether or not you think that's going to benefit future operations. So I think this is kind of what we're looking at here. Higher product and transportation costs, pressure from shrink during the second half of the year, and investments in our supply chain network, offset by the benefit of higher retail prices along with favorable product mix. So which ones of those are sustainable? Higher product and transportation costs decrease gross margin. Well, those are probably permanent. Both of those sound like inflation to me. So that's something that management has borne the brunt of. So they're paying higher costs, they're paying higher transportation costs for their raw materials, and they haven't yet been able to pass those costs along in their pricing. Pressure from shrink during the second half of the year, that's probably temporary. And investments in supply chain network. So I would ask a whole bunch of questions about the investments that they made in their supply chain network, because that could be a really good thing that's going to produce synergies in the future. Because when you make those investments, typically you expect a return on that investment. The returns on those investments should show up in higher margins. But I would want to know exactly how is your company going to do that? What were those investments? When specifically can we expect them to affect margins in the future? And then a few options. So I walk you through those disclosures in hopes that I can just impart a little bit of thought process as you're making the same application to the companies that you're working on. And there are authors on slide 26. They give us a whole bunch of what I would hope to be common sense type reasons to explain fluctuations in margin. So just pick a bullet on this slide. Margins go up, margins go down. Maybe that was attributable to more generous sales discounts or sales return policies. Well, if you have more generous sales returns, discounts, or policies, that would likely explain margins going down. If you have less generous sales discounts and sales policies, that would likely explain margins going up. Reasonable, rational, self-explanatory type bullet points there, all of which could cause margins to fluctuate up or down. Inventory turnover, slide 27. This is one of for module 6, when you do your report, we're compiling an analysis of all of these ratios. And I'm looking for some explanatory paragraph that will impart to me as the reader that you took a look at these ratios and made an attempt to understand what was driving them, just like we looked at in fine print. So inventory turnover is a measure of efficiency. I want you to take a look at the companies that you're working on and calculate inventory turnover, which is cost of goods sold divided by average inventory. Another measure of efficiency that's very, very similar, it gives us the same data, only we're measuring it in something called days inventory outstanding, which is 365 divided by inventory turnover. So it's basically just inventory turnover in a different form, but I'll show you how that works here in a moment. This is Home Depot. For Home Depot, we have inventory is 104, that's probably billion, 104 billion. Divided by. Average inventory, I guess that's sales. Sales. Is that right? I'm getting confused. Cost of goods sold, excuse me, cost of goods sold. Of 104 billion. Divided by average inventory. So you get beginning inventory plus ending inventory divided by 2. Gives us inventory turnover of 4.46 times. Divide that into 365 days per year, and we're turning that inventory every 81.9 days. Which equates to 4.5 times per year. So now we have a baseline to work with. We know what inventory efficiency numbers were for 2023. Let's look at 2022, 2021, 2020. Is Home Depot improving those measures of efficiency, or maybe they're going in the wrong direction? So here's our days inventory outstanding for looks like 8 or 10 different industries as tracked by the S&P 500. You can see that textile, apparel, and luxury goods turn over their inventory about as fast as any inventory out there. Oil and natural gas, very capital intensive business, a little less so. Okay, interpreting DIO, very similar to gross margin. This slide gives you some common reasons that your days inventory outstanding might be getting better, improving in quality, or getting worse, deteriorating in quality. Pull it off this screen here. You can attribute that to product mix, promotional policies, improvements in manufacturing efficiency, just-in-time inventory systems, demand pull. This is where the legwork comes in of being a financial analyst. You have to read the management discussion, talk to the management teams. You might be able to pull that from an analyst report. Let's look at days payable outstanding. So just like we can look at inventory and make some assessment about how efficiently management teams are utilizing their inventory. We can do the same thing with accounts payable. So accounts payable turnover equals cost of goods sold divided by average accounts payable, and days payable outstanding equals 365 divided by accounts payable turnover. So this gives us some indication of, how quickly we're paying our vendors. So accounts payable turnover. I think this is Home Depot we're looking at again, 8.4 times. So days payable outstanding, 43.4 days. Earlier in the semester, we looked at Apple, and we looked at Apple's cash conversions. This is one of the components of the cash conversions. And I told the story about how powerful Apple is. They have so much leverage over the original equipment manufacturers that they do business with. They can basically tell them, we'll pay you when we feel like paying. And when we feel like paying you, it's going to be after we get paid. So first send us to inventory. We'll make phones out of that inventory. We'll ship our phones around the world. We'll sell those phones. We'll collect the money on those phones, and then we'll think about paying you. And the OEMs that do business with Apple are like, great, biggest supplier in the world, maybe second Samsung, but certainly most profitable supplier in the world. They jump at the chance to participate in Apple's supply. Home Depot is a little different. They don't have that much bargaining power over their competitors, but 43.4 days to pay your bills is not bad. Here is Home Depot's cash conversion cycle. So we have days inventory outstanding, 81. Days sales outstanding, 7.8. They don't have any problem collecting. Days payable outstanding, 43, for a cash conversion cycle of 46. And we would want to track that over time too. You can see their cash conversion cycle jumped from 32 days in 2021 to 46 days in 2022. Primarily driven by a jump in days inventory outstanding, to a lesser degree, days payables. Primarily days inventory outstanding. So, and again, from 2020 on, from 65, 70, 81. Likely COVID had something to do with that, exactly how it affected Home Depot's inventory management system. I definitely want to know more about that if Home Depot was the company that I was working on this semester. People started shopping at Lowe's. One of the bullets on the prior screen there. So this is an example of a handy graph that you can put together. You don't even have to build these yourself. If you go to FactSet, you can just download this, but it gives you an indication of what has happened to those metrics. So significant increase since 2020. Looks like that number in 2022 was as high as Home Depot's been since 2013, even higher. So that's interesting. Wonder what's going on there. Okay, let's talk about depreciation. Nothing tricky about depreciation. When we buy property, plant, and equipment, it ends up on our balance sheet, just like any asset. This is typically under long-term property, plant, and equipment. And as the useful life of assets expires over time, it's our job as accountants to make sure that we transfer some of that cost over to the income statement in the form of depreciation expense. That from our net profits and ultimately becomes a tax shield, very similar to the inventory that we were just looking at. In order to do that, we have to know three things. We have to know the useful life of the asset. And this is, say we have a piece of machinery or a truck or something like that. We need to know the salvage value of that asset, and we need to know the depreciation method. 1 and 2 are easy. 3 comes in a variety of forms. 1 and 2 are usually going to be given to us by the author of the text if we're working in a problem, or by a company that we're analyzing. So in this example, we have cost less salvage value. So we have $100,000 piece of equipment. The salvage value is expected to be $10,000. So the depreciable asset is now $90,000. The estimated useful life is 5 years. When we have a piece of equipment with a 5-year estimated useful life, we're simply going to expense 1/5 of the value of that piece of equipment every year for 5 years. 1/5 of $90,000 is $18,000. So our depreciation expense is $18,000 for 5 years. And that's straight line depreciation, and that's the easiest of the 3. What you typically see, and here again, I want you to analyze each of these with your analyst hat on and come to some conclusion about whether or not there might be an opportunity for your management teams to manipulate this, play some games with the accounting again, because they could be using accelerated depreciation, units of production, modified accelerated cost recovery systems. Each of these will result in a different calculation for depreciation. Each of these will result in a different earnings per share. Each of these will result in a different tax treatment. And we don't get into it in module 6. But later in the semester, when we talk about module 7, we're going to come back to this topic, because when we look at straight line depreciation and we compare that to an accelerated methodology for calculating depreciation, we're gonna look at the same concept through a different lens. That is the lens of tax reporting. Depreciation, the IRS allows us, just like for inventory methodology, we have to select LIFO or FIFO. For depreciation, we don't have to pick. The IRS allows us to select straight line when we report financials to the IRS. And they allow us to select an accelerated methodology when we report financials to Wall Street. So we have two sets of books. Now, that's a whole class of discussion that you have to look forward to in module 10. We'll take a deep dive into those two sets of books, talk about how they're created, talk about how we reconcile those two sets of books with deferred tax assets and deferred tax liabilities. So that's just a little preview of what's to come there. Research and development. Okay. Okay. Research and development facilities and equipment are not immediately expense, and then there's a period. Like, that's just the way it is. What I went. I'm gonna take you back to 2000. 2002. No, before 9/11. That was 2001, it was the summer before 9/11. June of 2000. And I was interviewing on Wall Street for a company called Sanford Burns. And they were wanting to hire somebody to come work as a telecom. mechanic. And I had a job working in Sprint. And we were in the middle of the telecom, media, internet, call, and everybody was making money. We were, at the time, I was working on the coolest project that you could ever imagine working on, which sounds funny today, but we were working on a project where we were gonna put the internet on the phone. Which was unbelievable at the time. We thought that we were, we thought it was the best, the most exciting project we could ever work on. And anyway, so I go to interview in New York, and it was the whole day's worth of interviews. I think I had like 4 or 5 interviews with different people, and they would test me during an interview. They wanted to know how to be an animal. And one of the questions that I got wrong, I don't remember it my whole life. I got it wrong. Was a woman who asked me, is research and development expense or capital? That's what we're talking about right here. And remember that word to capitalize, capitalization means you put it on the balance sheet. Expense means it goes on the income statement. So what she was asking me was, what do you do with research and development costs? Put them on the balance sheet as an asset, or do you run them through the income statement as an expense? So research and development, book that you've probably already read that answer, but if not, you know, what would you think the answer to that question is? It's tricky. It's tricky. The correct answer she was looking for, the quote unquote correct answer was expense. Most of the time, you see research and development expense, just it's research and development expense. It almost always comes right after that terminology. Where I got caught up with it was because I had been studying too hard for the CFA. We're in the nuances associated with a couple of wrinkles that represent instances where you would actually capitalize research and development. So, for example, research and development facilities and equipment. If it's a facility, meaning that the whole building is devoted to research and development, or if it's equipment, like some pharmaceutical manufacturers have very specific equipment that they buy for research and development, you might not necessarily expense those immediately. So if they are general use in nature, costs are capitalized. So there is an instance where you would capitalize research and development, but I want to make everybody aware so they don't suffer from my big mistakes. That 99% of the time, you're going to expense research and development. I did end up getting that job offer though, so they weren't too disappointed in me. Okay, let's see, slide 42, covered that. Want to make sure I get a few other things covered tonight, so I'm gonna skip. Okay, restructuring costs are covered on slide number 47. I wanted to revisit a conversation that we had a few years ago where I expressed some frustrations about companies using a category called restructuring costs to mask certain bad decisions that might be made manifest as a result of a history of bad acquisitions or just bad decision making by the management team. You can flow all that through restructuring costs. Our authors did that here again in module 6, where they say corporate restructurings might be caused by poor performance, managing that, shareholder pressure, all kinds of different reasons that you might see those. And I would just encourage you to do some digging if you do see restructuring costs, especially if you see a pattern of it, because it can be indicative of a management team that might need to be replaced. Okay, let me move all the way to PP&E. Okay, property, plant, and equipment. This is Home Depot's property, plant, and equipment footnote. Find this for the company that you're working on, familiarize yourselves with all of the major assets in their PP&E line. We're gonna want to look at some of the same ratios, some very similar ratios for property, plant, and equipment. You know, how many dollars worth of savings does the company get out of every dollar of property, plant, and equipment that they invest in? Calculate something like that. We'll look at property, plant, and equipment turnover, sales over average PP&E. So in Home Depot's case, we have $157 billion worth of sales divided by average property, plant, and equipment of say 25 billion or 6.2. Home Depot gets $6.2 worth of sales for every dollar's worth of property, plant, and equipment that they have on their balance sheet. You can see that represented here graphically, much like we took a look at days inventory outstanding by inventory, we can do the same thing, by industry, we can do the same thing with property, plant, and equipment turnover. It's the capital intensive companies, industries like oil and natural gas that are going to be on the low end. And the capital light industries like capital goods, semiconductors that have higher numbers in that regard. Okay, let's talk about intangible assets. That can be a tricky one for some students that haven't had accounting in a few semesters. An intangible asset is any asset that can't be attributed to something specific on the balance sheet. Most of the time, these occur as a result of mergers and acquisitions. So when company A acquires company B, the price is negotiated. And then the accounting for that transaction takes place like this. Company A buys company B for $100 million. Then they take a look at company B's balance sheet. Company B's balance sheet may have $80 million worth of identifiable assets. Okay, great. They know that they bought those $80 million worth of assets. That's easy. Take those assets, put them on your balance sheet. What do you do with the other 20 million? Well, you spent 20 million, you have $20 million worth of cash Now you got a $20 million transactional hole unless you identified something that you just bought. Well, that something that you just bought is an intangible asset. And that intangible asset is generally booked as goodwill. Sometimes you can book it as customer relationships, unidentifiable trademarks. See all sorts of different labels for those intangible assets. The way that we look at those over time is to determine if they're still worth what a company paid for them and make an assessment about whether or not we might need to write those down on a periodic basis. Let's look at an example of that here. Slide number 68 is a great slide that our authors give us, covering looks like 6 major asset categories, or 6 major categories of intangible assets, including marketing related intangible assets, customer related, artistic related, technology based, contract based intangible assets. Any one of those could be used to attribute the $20 million chunk of value that I just laid out in that example. AMD's acquisition of Xilinx. So in this example, AMD buys Xilinx and they go through Xilinx's balance sheet, which is right here in blue, and you can see that they have cash and cash equivalents of 2.3 billion, short-term investments, accounts receivable, inventory. This is their balance sheet, and they're going to record all of these assets on AMD's balance sheet. The acquirer will take all of these and basically just add them to the account values that you have on your balance sheet, and you get down, and then you're going to try to fill that hole, and they plug it right here with goodwill. They have $22 billion worth of goodwill that they have to now book on their balance sheet. They have to create that asset on their balance sheet, representing something intangible about Xilinx that was worth AMD writing that big check for. And if you get a little further into the detail here on this next slide, you can see that that $27 billion worth of intangibles is further broken down into developed technology, customer relationships, customer backlog, corporate trade name, product trademarks, and so on and so forth. So now it becomes our job, if we're looking at this transaction maybe 3, 5, 10 years in the future, we're going to go back and we're going to see intangible assets of 20 billion. And we want to look at that developed technology. I don't know what that is, but we would have more detail about it. Those customer relations, those customer backlog. We would want to come to some conclusion about whether or not that was still worth $20 billion. If AMD is running the company right, that might be worth a lot more than $20 billion. It might be worth 30, 40, 50 billion. As an investor, that's what we want to see. If, as is so common the case, management got a little greedy when they were engaging in this merger and acquisition activity, you'll see the $20 billion number become impaired over time. You start to ask questions, be like, well, there really is no customer backlog. You know, we lost all that business to a competitor when we tried to merge the businesses. Well, maybe there really is no corporate trade name. Maybe Xilinx doesn't exist anymore, and that corporate trade name isn't worth anything. And you know, we sold that for pennies on the dollar. If that's the case, you're going to have to go through a process where you value those intangibles and potentially write them down. To value intangibles, you can take a multitude of different approaches, and our authors list a handful of them here. So these are all valuation models specifically for intangible assets. So the relief from royalty method assumes that that intangible asset is on our books because it gives us relief from a royalty that we would otherwise have to pay if we didn't have the rights to that intangible assets, such as trademarks, licensing fees, software licenses, so on and so forth. So we can ask ourselves, well, if we didn't have this intangible asset, we'd have to pay licensing fees to use the software. Those licensing fees are, maybe we have Maybe we know that. If we know that number, then we can just say, well, 10 years worth of licensing fees would be $5 billion. We can value those intangibles. So I don't expect for you to have any homework problems or any problems on your exam that would require you to value intangible assets. Just familiarize yourself with a couple of those techniques. You might have to identify what a relief from royalty is. Okay, and I just wanted to cover one more thing tonight, might get you out of here a little bit early, which is the accounting for goodwill. So goodwill is not amortized. We don't amortize goodwill like we would property, plant, and equipment. Rather, we put that through a periodic assessment for any impairment that might have occurred since that intangible or any intangible really ended up on the balance sheet. And in order to make that assessment, we have next valuation techniques like the one that we described on the prior slide. And that's pretty straightforward. Once we apply those fair value assessments, if subsidiary's fair value or that piece of goodwill is less than the carrying value. So if our assessment of that value, fair value, is less than the carrying value, we're gonna have to make an impairment. And an impairment is nothing more than loss on goodwill. Flows through the income statement as a loss, reduces our net income, reduces our earnings per share, and ultimately it's a black eye on management. Okay, that's it. That's everything I wanted to cover for module 6. I'm very hopeful that the accounting part of that is pretty straightforward. As you look at some of those ratios across time and across period, I'm hopeful that this lecture will allow you to ask some questions, draw some insights. All I got. Thanks, man. Appreciate it. I'll see you in 2 weeks and I'll send out a reminder to everybody that wasn't able to make it tonight.